Okay, so liquidity, in interest in liquidity, because when dividends have been declared, it must be paid. And liquidity has to do with ability to meet your maturing debts. So that's why they're interested in liquidity. Okay, we will discuss as we go on. So what we need to understand is that if we are doing the financial statement analysis, we need to do it to suit the particular interest. So if you're doing it for a shareholder, your analysis will be different from if you're doing it for, say, a short-term creditor. So that's what we need to understand. Now, when we're doing financial statement analysis, we are doing it using the financial statement. We need to understand that the financial statement is a communication tool. So when you pick the financial statement, it contains important information that can help users take decisions. But there are several parties that have roles to play in the communication process. They include management, external auditors, analysts, and government regulators. So every party has a role to play, and if they are playing their roles well, then the information that gets to the user will be useful one, and they can take an informed decision. Now, when we look at management, their role is the preparation of financial statements. So that is the role of management, and they prepare it using the general accepted accounting principle. And we mentioned that the general accepted accounting principle enforced in Ghana is the IFRS. So whether you're using the full action amount or you are using one for SME. So management has a role, and their role is the preparation of the financial information. Now, when management has to prepare the financial information, they represent their assertions, and you need an independent party to verify those management assertions. So we have external auditors, and their role is to provide assurance as to the content of the financial statements. So external auditors have a role to play, and their role is to assure or to provide verification about the assertions of management. Then there are some companies, by the nature of their activities, affect the public. And because they affect the public, a government institution or agency will be responsible for their activities. So that, and especially as regards to their finance, as regards to their governance, and they obeying regulations for that kind of industry. And so government agencies or regulators play a role or additional role of verification, and they ensure that the information that is contained in the financial statements reflects a true and fair view of the state of affairs. So we have, and if you operate in any of such sectors and you do not comply, then there are sanctions that will be applied. So for instance, if you operate in a bank, then Bank of Ghana will regulate your activities. They will want to ensure that what you are declaring as profit is a true profit, whether you have made provisions for bad debt, whether the expenses that you are done are bona fide. Otherwise, then they will ask that the parties that have committed the business must be sanctioned or reimburse the company. So we have government regulators, and they regulate specific sectors of the. Can you identify any government regulator and the kind of sector or industry that they regulate? Yes, Priscilla. Priscilla, if you're not asking a question or answering a question, then pull your hand down.
Sorry.
Yes, Elizabeth. Yes, Elizabeth. Mavis. Benson, mute your microphone.
Bank of Ghana.
Okay, so we just mentioned Bank of Ghana. I will say that for the banks.
Oh, yes. Please, how about SEC?
If you want to ask it, just say it. Don't say what about.
Yes, please. SEC. Security Exchange Commission. Exchange Commission.
What kind of industry or thing?
That's a fund management company. Savings and loans. Yes, please.
Great. Okay. Is that savings and loans?
Yes, please.
Under SEC?
Yes.
Savings and loans?
Oh, so it's only fund management companies.
Okay, all right. Francisca?
So please, GRA, the Ghana Revenue Authority.
What kind of business?
They are interested. They want to know how much tax should be apportioned to a company. So they are interested in the financial.
What we're discussing are parties that have a role to play in the communication of financial information. And here we look at financial statements. Okay. So how would GRA be a government regulator as far as the information that is passed on to users? Matilda?
Yes, please. National Communication Authority. They regulate the telecom company.
Yes, but the regulation is not related to accounting and finance.
Okay.
Yes, Patience. Patience.
So I wanted to say, I wanted to mention something that is not related to financial statements.
But you can talk about the Ghana Stock Exchange for company listed on the exchange. You can talk about the National Insurance Commission for insurance companies. All right. So they provide further verification. Then we have other parties that break the information down so that people can appreciate the financial information on the basis of activities. So they provide advisory services. Can you give examples of companies that provide advisory services? Yes, Solomon. Yes, Solomon. You don't know of any company that provide advisory services? Yes, Belinda.
KPMG.
Okay, KPMG. What do they do?
They are external auditors, and I think they are external auditors, and also they give advice to companies.
So, but we're talking, yes, so they provide advisory services. So, if you
hello, Doc.
Yes.
Please, sorry, my phone was largely giving me a problem. I wanted to find whether Bank of Ghana could be one.
For what kind of?
Like, since they also regulate most of the activities of the banks.
So you're talking about government regulators?
Yes, please.
But that's what we've been discussing all along. It means we're not listening.
I was focusing.
You were what?
I mean, I was listening.
But what I'm saying is that is the first example we give.
Oh, okay.
If you were listening, then you would have heard that we talked about Bank of Ghana regulating the banks.
Okay, got it on my network. I raised my phone earlier. You called me, but the network was actually giving problem.
Okay, all right. That's okay. Now, when we're doing financial statement analysis, we have said that we do it to suit the interests of a particular user or particular stakeholder. But when we're doing the financial statement, we can have some common objectives. And some of the common objectives include assessing the historical operating performance and financial health of another entity. Okay, so if we're doing the financial statement analysis, all we're seeking to do is to use their past information to assess their financial health. And yes, Kelvin. Yes, Kelvin. Belinda.
Sorry, sir, doctor, please, it's the previous hand.
Okay, so we're assessing the historical operating performance and financial health of another entity. It could be a supplier, it could be a customer, or it could be a competitor, or whoever that you have in mind. But basically, if you see that companies have advertised for suppliers, you ask that the suppliers should apply, and you ask them to provide certain kind of information. Now, the information that they may ask them to supply will include the financial statements over a certain period. Why would you think that people want to assess the financial health of a supplier? Are you in class?
Yes, sir.
Yes, sir.
Your voice is low. Bismarck.
Please, they want to know the health of a supplier just to involve them in their planning, especially what they need from the supplier. They must be sure that the supplier will be able to supply it, and also on time.
We are assessing the historical operating performance to determine the financial health. Why do we have to determine the financial health? Yes, Randy.
So I believe most contracts given out to suppliers the suppliers might need to use their own money to run or to supply the product before they are paid at the end of the month. So once you are able to know their historical, you can know if the liquidity, if they have money to run such a venture, maybe before payment is done to them.
Okay, so you are assessing the financial health because you want to know the financial muscle of the entity, whether they will stay in business. Because once you select them as suppliers, effectively you tie your business to theirs. So anything that happens to them can disrupt your own business. And that's why it is important to know the financial health of a supplier. What about customers? Yes, Louis.
So you need to know the financial health of your customer to be able to know how to set your price. Because
to set your price.
Yes, sir.
So you know the financial health of your customer before you set the price.
Yes, sir. If you have regular customers that are always patronizing from you.
Okay, so Randy.
So for customers, I believe to know their purchasing power, if they can be able to buy your goods and services.
Yes, Peter. The financial health of your customer will help you determine the quantity of goods to produce for them. Babies. Yes, babies.
So that in case they credit stuff from you, you can know whether they can.
It's basically to extend credit. It's basically to extend credit. So you, before you extend the credit to the customer, you want to know whether they can pay back. But as to knowing their financial health before you set your price and all that is way off. Okay. So basically, if you are selling goods and somebody comes and they say, how much is it? Say 50,000. This is your money. Do you have to assess their financial health? No. But if they are going to pay over time, or they are not paying immediately, then you want to assess whether they can pay when the time is due. That's why you want to assess their financial health. Okay. What about a competitor? Should you assess the financial health of a competitor?
Says to use them as benchmark in assessing your price and so you'll be able to serve your customers well.
Okay, yes, James.
You need to know their performance and see how the competition will be in the future.
So you need to know the basis of competition, and you want to know their financial muscle or financial health, so you can also determine how to compete. So if they have a very strong financial health, then you may get crushed if you decide to pitch your strength against them. If you recollect that not long ago, the telcos were doing promotion. One of them said, we are going to give 3 Otieku. Then before you could say that, another said that 25 free jewelries. Now, so you need to know the financial health so that you can compete appropriately. Because if you don't know their financial health and you pitch your strength against it, they may catch you. That's why it is important to know the financial health of your competitors. So if you cannot compete head on with them, then what you have to do is to create a niche and just operate within that niche. So it is important to know the financial health of your competitors. Now, when we do, yes, Theophilus.
So also knowing the financial health of your competitors will also inform you on if there is a possibility to buy them off in case they are suffering financially, so to control the market.
If it's a weaker one, then you want to see whether you can harness them. Correct. We also do financial statement analysis so that we can understand the dynamics of the firm. We want to know what makes the business tick, and on the basis of that, we can predict accurately the future profitability and risk. So, doing the financial statement analysis over time will now help you identify the key variables that are important as to the operations of an entity. Now, once you're able to identify those key variables, then when you want to determine the future profitability and risk, you can use those variables to do that. Okay. So if you are doing works as far as the banking industry is concerned, so the key variables could be competition. Competition is a key variable. Okay. Now, you could also be looking at technology as one of the key variables. Okay. You can also look at the non-performing loans as a key variable. So if you understand these variables, if you have to predict future profitability and risk, it will be easier to do that. But if you do not understand these variables and you don't have them, then it will be difficult to take this or to forecast the future profitability and risk. So it is important, and as you do it over and over again, you get to understand these factors and can help you to do a good prediction. Now we have said that we can do future for profitability and risk, an assessment of future profitability and risk. Now when we do the assessment, it helps us to take some other decision. So the assessment of future profitability and risk is not done for its own sake, but it is done to help take some other decision. And they could include if you want to make an investment decision. So when you assess the future profitability and risk, you may decide whether you should buy shares in a company or not buy shares in a company. So it's assessment of future profitability and risk that can provide a basis for you to make an investment decision. Okay. The assessment of future profitability and risk can also help you make a credit decision. So you may decide whether you want to extend credit to another company or not extend credit to another company, or if you already have extended credit, and as you assess the future profitability, you may call credit because your money will be at risk. So the assessment of future profitability and risk can help you make a credit decision. The assessment of future profitability and risk can also form an input in the valuation model of a business. So if you are valuing, if you recollect, when we're looking at the valuation of assets, we said that it can be present value of future net cash flows. So the assessment of future profitability and risk can now help you determine the free cash flows associated with the business, and on the basis of that, use that to value. And especially when the business is making profits, then just adding the separable assets will not be a useful method to value. So the assessment of future profitability and risk can help you value a firm. We can also look at the future profitability and risk as a basis of determining whether the business will continue to operate into the foreseeable future or the business will go bust. Now, if we assess the future profitability and risk and the business will continue to make profits into the foreseeable future, then we see that the company is a going concern. But if we assess it and the company will continue to make losses, then the going concern status may be impaired. So the assessment of future profitability and risk can help us determine whether the business continue to operate into a foreseeable future or it will not be able to operate into a foreseeable future. And finally, we can also use the assessment of future profitability and risk as an antitrust measure. So if we assess the future profitability and risk, and especially if the regulator assesses the future profitability and risk, and they determine that if two or more companies are going to combine or take over or whatever it is, and it will put them in a monopoly situation, then they will say no, because the welfare of the citizens will be compromised. So if they do that, they say no, we will not allow this to happen. So we say that we are using it as a mechanism for antitrust. So these are some of the common objectives for which we do financial statement analysis. Any question, comments? Theophilus, is your hand up or is the previous one? Yes, Randy, you have a question? Okay, all right. Now let's look at the standards that are there to do evaluation. We will skip this one because we have discussed them already. So we are looking at the standards that are there to do the evaluation. Basically, we can look at benchmarks that can facilitate the analysis, because when we do the analysis, one of the key things that we do is comparison, and the standards that are there to help us to comparison will include the company's own set of data. So, and the company's own set of data can be past data or future data. So, if we are evaluating farm milk, we can use, and we are evaluating 2020, we can use 2019 as a standard. So 2019's performance of standard farm milk and 2020 performance of farm milk, and we're comparing 2020 to 2019. So we're using 2019 as the standard. So that is the company's own set of data, and it's past data because we are in 2020, or we evaluating 2020, but we are using 2019. We can also evaluate using future data. So we can look at the budget and compare the current performance with the budget, and the budget is a future data. So if we do this kind of analysis, then we are saying that we are doing an intra-firm comparison. So where we're using the company's own set of data, then it's an intra-firm comparison. Then we can do an inter-firm comparison. An inter-firm comparison means we are comparing with another entity. So we have, say, franchise, and we're comparing it with Ecobank. So that would be an inter-firm comparison. We're using another company as the standard. Now, when we are doing the inter-firm comparison, we need to be careful as to the choice of the standard, because the choice of the standard can really affect our analysis. So, for instance, if we're evaluating Ecobank, can we use Shegrege company as or Special Eyes? Okay, let's see Special Eyes. We're evaluating. Why not?
Yeah, because there are two different entities. One is a financial company, and then one is a water producing company.
Okay, all right. So what he's saying is that if we want to do an inter-firm comparison, technically we can do it, but if we want the best results, then we should choose entities that operate in the same industry. Because you're saying that this is financial institution, this is water producing institution. So the first rule we make for ourselves is that we should choose entities that operate in the same. Okay, choose entities that operate in the same industry. So that's the first rule. Now the second rule, or let's see, so we are still evaluating Ecobank. I want to use Omni Bisec. Is that the name? The right pronunciation? There's a bank called Omni Bisec. Can we do that kind of comparison? Or you don't know the bank?
So we don't know the bank.
You don't know the bank?
Yes, please.
Okay, best point. So best point. So you compare Ecobank to best points. Can we do that?
Yes. So they are savings and loan, and Ecobank is way ahead.
So let's use Omni Bisec. Yes, this one. Yes, Bismarck.
Sir, please, I think we are not supposed to compare Ecobank with Best Point, because Ecobank.
We have revised it. Please. We have revised it. So we are using Omni Bisec, Ecobank and Omni Bisec. Okay, so or Ecobank and ADB. Yes, Randy.
Okay, Ecobank and Omni Bisec, you can't compare because Ecobank is an international and Omni Bisec is just a Ghanaian bank.
Omni Bisec is a Ghanaian bank.
Yes, please.
So we can compare EcoBank and other commercial banks.
Based on assets, and Omnibus would have lesser
So
assets.
don't use that as a premise that this is an international bank and this is EcoBank. But essentially, what I'm drawing attention to is that when you're doing the analysis, you should consider size.
Okay, sir. Thank you.
So size is important in the analysis. So look for companies that are of a similar size. Now, if we talk of size is a phenomenon that you cannot measure directly. So what you do is that you use certain processes to represent size. Okay. So but if you are choosing the process for size, you must also be careful that it is useful for the kind of industry that you want to do the assessment. What are some of the size processes that we can use for size? What are some of the processes that we can use for size?
So the assets that they have, the kind of assets
so the balance sheet size. Okay, so you can use balance sheet size. But as I mentioned to you, you must consider the type of industry. So if you mention any project for size, tell us the kind of industry that it will be useful. Yes, Jamal.
Can we also consider whether it's a public?
Don't say can we also consider. Tell us what you want us to.
Yes, so I'm looking at the size. Public companies work trading on the stock exchange. Their size is different from the normal companies who are not trading, who are not public companies.
Which one is the normal one? Which one is the abnormal one?
Those who are not trading on the public, they are not public companies. They are not trading on the stock exchange. Some banks are not trading.
When we discussing, I mentioned to you that if you say a company is a public company, it does not necessarily mean that the company is listed on the exchange. The exchange is a market. So you can be a public company and not listed on the exchange. Yes, Elizabeth. Yes, Elizabeth. Kelvin. Kelvin. I'm taking note of all of you who are refusing to answer questions. So when the time comes and if not giving you much, you can't blame anybody. Yes, Jamal.
The size of capital.
Okay, so for which kind of business?
So when you're going to look at it, when you're going to consider the size of the business, we look at the size of the capital. Let's say, as we're doing the comparison of EcoBank and UT Bank, we look at the size of their capital, they will ask to determine the size, and that will be the benchmark for that. And we also consider maybe the size of the shareholders as well. And we can also consider maybe the branches. Yes, Prof.
You need to listen to the question and provide an answer to the question.
Okay, Prof.
Yes, Bismarck.
So please, I wanted to talk about the branches with the financial institutions.
Okay, so you are talking about branch network.
Yes, sir.
Okay, so if you talk about branch network for financial institutions, assuming we have one that is operating these kiosk kind of branches, and we have one that is operating a full range of service, can it be comparable?
No, sir. Depending on their capital base, you can just compare those in this model.
So look at the original branches of GN Bank and look at the branches of Commercial Bank, GCB Bank. So if we say that you GN Bank has 320 branches, and GCB has 240, so or maybe 300. So because of that, you're using branch network as a basis for size. But GN Bank cannot be compared to Ghana Commercial Bank because the branches were more or less like kiosks for GN Bank as compared to GCB. Okay, so for the telcos, what do you think should be the best proxy for size? Calvin. Calvin, you raise your hand, we ask you a question, and you will not respond. If you will not respond, you don't have to raise your hand. Yes, Emmanuel.
Yeah, I think the infrastructure for network coverage.
Infrastructure for network coverage.
Yeah.
Okay, but now the coverage, the network infrastructure, are they still owned by the telcos?
Yeah, now most of them do co-location though, but I think co-location is more like renting, so it's still probably their infrastructure, they are using it. So how widely you can cover within the country will also tell the number of people that would join your service. For instance, if Glo doesn't reach the northern part of Ghana and MTN is there, obviously people living around the north would prefer to use MTN.
Okay, all right, great. What about the number of subscribers?
Okay, number of subscribers to count. It also counts. Number of subscribers to count. Yeah, I think so. It's also a major factor because even though, okay, let's take for example Glo. Glo has a lot of infrastructure all over the country, but but MTN has more subscribers than Glo, and I think that one also has determined the size.
All right. So the rules we have made for ourselves when we're doing an interfair comparison is one, to consider whether the entities are operating the same industry, to look at the size. Now we can also consider whether the entities are employing similar accounting methods or policies. So if you recollect when we talked about depreciation, okay, we said that there are several methods, but we have the straight line method and we have the reducing balance method. Now, so if two entities bought a similar asset and one is using the straight line method and one is using the balance method, the amount of depreciation is different. Now, so if that is the case, it will affect their profits. So if you don't consider the accounting policies, then your analysis may not be wholly true or a true reflection of what exists. Now, so what you do is that you must also choose entities that employ similar accounting methods. Okay, so choose entities that employ similar accounting methods. And sometimes it may be difficult to have entities that operate in the same industry that are of a similar size and also employ similar accounting methods. Now, once we do identify an entity, but the difference is the accounting method. Then what you can do is to restate the financial statement. So if you are restating the financial statement, it means that you will now abandon the policies of one of them and rework it using the other entities' policies. Now, if you do that, we say you have restated the financial statement. So that could be a way out. So remember that if you are doing an inter-firm comparison, it is important to consider certain factors, including whether the entities operating the same industry, whether of their similar size, and also employing similar accounting methods. We can also look at industry data. So when industry data exists, then we can use industry benchmarks. Now, what happens is that if you look at specific industry, the industry may be segmented. So we will have those that are doing very well and those that are not doing well, or it may be segmented based on size and all that. So we have the tier 1, tier 2, and similar categories. Now, what is important is that if we do not have such categories, if there's a dominant player and you put the data of the dominant player into the average, the industry average, it will distort the industry average. So even though we can use industry data, but we need to be careful that the average is a true reflection or representative of the entities that operate in that industry. So for instance, if you're looking at say the telcos, once you bring in MTN data, it will distort everything. So it's important to know the distortions that a dominant player's data can bring. Do you know of any industry kind of segmentation or categorization that may exist? Do you know of any industry? Yes, no. Yes, 2 floors.
So I'm citing our education system as an industry. Tier 1 schools, tier 2 schools, and then the grade A.
Which one? So which type of education are you talking about?
Second, senior high. Senior high. So is it appropriate to cite that as an example?
Well, you can do that.
Thank you.
You can do that. Yeah. But we more or less looking at profit-oriented organizations. So our example should reflect on profit-oriented organization.
Thank you, sir.
If you go to the banks have their teams. Any question? Any question? All right. Now let's look at the sources of information. Give me, yes, Erasmus. Do you have a question? Erasmus. Yes, Charlotte.
Sir, I wanted to mention Unilever and then Nestle Ghana.
As what?
You mentioned of companies that do segmentation. And I wanted to find out if that's correct, because Unilever, they have the soap production section.
So we're talking of industry.
Okay, sir.
So if you look at the fast-moving consumer goods, they can be segmented. So you have those who they could be segmented based on several indicators.
Okay, sir. Thank you, sir.
Okay, so give. So welcome back. We're now looking at the sources of information to do the analysis. Because we're doing financial statement analysis, then the main source of information is the financial statement. So okay, so you asked whether we can compare EcoBank savings and loans to Best Point savings and loans. Yes, we can do that. But we're looking at the source of information, and I'm explaining to you that because we're doing financial statement analysis, the main source is the financial statement. So the financial statement will come as part of the annual report. So if you see the financial statement, usually there will be other reports that will be attached. If you recollect when we're discussing financial information, so the annual reports will include the financial statement. So the parts that should be of interest to you and that can help you in the analysis will include the session that management have evaluated the performance of the business. So we can talk of management analysis and discussions. Then we can look at the main components of the financial statement, including the notes that accounts. Then we can also look at the auditor's report, see what kind of information is in there. Has the auditor given them a clean sheet? Or the auditor says no, there are material misstatements in the financial statement. Now, so it is important to look at all of these things. Then, for many companies, they will also include what they call the highlights, which will be a summary of past operations. So, financial statements are usually done on comparative basis. So, if we publish in 2020, we'll have 2019 figures attached or as part of the 2020 figures. Now, for those items that are of importance, you see that they will provide not for just the 2 years, but it could be for say 5 years or 10 years. So they represent the highlights, and they are an important source of information, especially if you want to see the pattern, whether there's a pattern. Okay. Now, apart from the information contained in the annual report and therefore the financial statements, there could be other sources that can help in the analysis. And some of these sources will come from the company's own sources, and others may come outside of the company. So if you look at the website of the company, they may provide fresh information that can aid your analysis. So if you go to the company's website, if the company has a magazine or has a journal, you can get information, useful information from it. But apart from the company's own sources, you could also get from other sources, including if there's a trade journal. If there's a trade journal, some important information may be contained in the trade journal. You will also get information from, say, if an expert of that industry has made the pronouncement. So if an expert of that industry has made the pronouncement, then that information will be useful to your analysis. You can also get information from government sources. So if you look at the government's budgets, annual budgets and estimates, and the policies that they want to pursue, it can also provide useful information that can help you in analysis. So if the government says that we are going to provide assistance to this kind of industry, then if you are doing analysis, then you should factor it in. If the government says that no, we are going to impose a lot of taxes, or we are going to strengthen regulation for this kind of industry, then that should also help you. So there are various sources that can help you in your analysis. Can you think of any other source? Can you think of any other source? Can you think of any other source? Yes, Abdul Manan. Can you think of any other source?
Maybe minutes of financial meetings.
What did you say?
Minutes from budget meetings.
Which budget meetings? Yes, Dennis. Abigail. Okay. So many more. All right. Any question? Any question? Now let's look at the tools that can be used to do the evaluation. So some of the tools that we want to discuss are horizontal analysis, and here we're looking at 2 years data. Then if we extend it to more than 2 years, to say 5 years or 10 years, then we're doing trend analysis. Then we can also do vertical analysis and also do ratio analysis. Now, when we are doing horizontal analysis, all we're trying to do is to determine percentage changes. So we want to determine percentage changes and use the percentage changes as a basis of our analysis. Now, to determine the percentage change, you need 2 years. And usually the earlier year is considered as the base. So if you have 1997 and 1998, 1997 we consider as the base. So 1997 is the base year. Now what you do is that you place them side by side such that the items correspond. So I've put 1997 against 1998. So when I mention sales, we know that it is $18,284 for 1998 and $16,701 for 1997. Similarly, if I mention 3205, you see that it is net income for 1997, and 3141 is net income for 1998. So we place them side by side. Now, I've mentioned that we choose a base year, and usually the base year is the earlier year. So 1997 is the base year. What we do is that we subtract the base year figure from the current year figure. So we're subtracting 16,701 from 18,204. So the base year from the current year. And that will give us the amount of change. So 1997 figure from 1998 figure will give us the amount of change. So if we subtract the 16,701 from 18,284, it will give us 1,583. So that is the amount of change. And once it is positive, it means there is an increase. Increase means there is growth. But if we subtract the base year figure for net income, which is 3,205 from the current year, which is 3,141. Because the base year figure is bigger than the current year figure, it will give you a negative figure. So when it's negative, we put it in parentheses. And once we do that, we will get the amount of change. And because it is negative, then it means that it's a decline. So if it's positive, it means that there's growth. If it is negative, it means there's a decline. Okay. Now, so that's the first part that you have to do to determine the amount of change. And once you determine the amount of change is expressed as a percentage of the base. So if you look at the amount of change for 19, the amount of change for sales, which is 1,583, that figure is expressed as a percentage of the base year figure, which is 16,701. So 1,583 over 16,701 times 100 will give you 9.5. So that is the percentage change, which is positive, representing growth. But when you look at the net income, the amount of change is negative 64. So negative 64 over 3,205 times 100 will give you a negative 2, which is a difference. So the first is the computation. So first you have to do the computation. Once you do the computation, then you can do the analysis. Now, if we're doing it for the income statement or the statement of comprehensive income, typically in the statement of comprehensive income or the net the income statement, there are two main items. One, they are income related, and two, they are expense related. So income related or expense related. Can you give examples of the income related items in the statement of comprehensive income? Can you give examples? So revenue, sales, profits, gains, they are examples of income related. Can you give examples of expense related? So, yes, Bismarck.
So purchases.
Okay, purchases. What else?
Wages.
Okay. We can talk of losses. We can talk of costs in general. Okay. So these are examples. Now, if you understand this, then it will help in your analysis. Now, there are levels of the analysis. The first one is that if income-related items are increasing, then they are good. So growth in income-related items are considered desirable. So if sales is growing, it is good. If it is income and it is growing, it is good. But if it is income-related and it's declining, then it is bad. So if sales is declining, then it's bad. If net income is declining, it is bad. Contrary, the expense-related items, growth in them are not considered desirable. So we don't, if expenses are growing, then it is not a good sign. But if the expenses are declining, then it's a good sign. Okay, so that is the first level of analysis. So just look at the income related or expense related, and once you are able to determine them, you now see whether they are growing or they are declining. And if they are income related, then growth in them will be considered good. If they are expense related, then they will be considered good. If you look at a lot of the financial statements that if you go to an AGM, the analysis that are done, most of them are this horizontal analysis. Okay. But what we need to understand is that we cannot grow revenue-related items, whereas expense-related items are declining. We cannot do that. So, as revenue-related items are growing, naturally, expense-related items will grow. So you can't say that sales will be growing and your cost of sales will be declining. No. So the next level of analysis is that we should consider relative growth. So not just that it's growing or it's declining, but we should consider the relative growth. So if sales is growing and expenses are growing, that would be okay because you need to grow your expenses for sales to grow. But relative growth in sales should be higher than the relative growth in the cost of sales. So here we are now looking at relative growth. So if an income-related item is growing, expenses will grow, but the income-related item should grow faster, or the rate of growth should be higher than the rate of growth for the expenses. So that's the second level of analysis. So the second level of analysis is that we should consider the relative growth and not just say that it is growing or it is declining. But what we need to do is to look at the relative. Okay. Now the third level of analysis is that we should not just say that this is revenue related or this is expense related. We should be looking at the individual items. And the individual items may tell a story. So for instance, if you are a business and you are depending on the expertise of your staff to generate revenue, then if you spend more money to train them, it should be considered desirable. So even though training for this kind of business will be an expense, but as a measure of efficiency or as a measure of protecting the future growth of the business, if you spend more money on training, it will be considered desirable. Or if you are into technology and you are spending more money on research and development, it may be considered desirable. So don't just look at the items and say that, or box them together and say that this is revenue related or this is expense related, and now decide that no, we don't have to increase the R&D because it's expense. We should consider whether is you spending on it will have impact on your future profitability. Similarly, you can also look at some income, and growth in them may not necessarily be desirable. So an example could be if you have a new CEO and the new CEO is selling the fixed assets. If they sell the fixed assets, they will make profits. But it is they are compromising on the productive capacity. So the board will not just come and start clapping for the CEO because he's selling the productive assets and making profits. Or you have a company that had prime lands and the CEO comes and is selling them. Once you keep on doing that, the business feature will be at risk. So even though you'll be making profits, but that profit is not desirable. So what we need to understand is that we should consider the type of item, whether income related or expense related, but we should look at them and now determine whether growth in them is desirable or decline in them is desirable. Any question? Any question? Okay, so that is the horizontal analysis. So the horizontal analysis, if we do it for 2 years, we can also extend it and do it for more than 2 years or for a longer period. Now, when we do it for a longer period, all we're trying to do is to establish whether there's a trend. So the interpretation is similar to this, but the methodology or how it is done is a bit different. You recollect that for this 2-year horizontal analysis, we look for the amount of change and express the amount of change as a percentage of the base. Now, when we're doing the trend analysis, what we do is that we use the absolute amount. So one, we are still going to choose a base year, and the subsequent years are expressed as percentage of the base year. We don't determine the differences or the amount of change. So if we have data of this nature spanning 1993 to 1998, 1993 they'll be chosen as the base year. And once we choose 1993 as the base year, all the other years will be expressed as percentages of the base year. So once 1993 is the base year, it is equated to 100%. Then the 1994 figure is expressed as a percentage of 1993, 1995 as a percentage of 1993, 1998 as a percentage of 1993. So if we did that, this is how it will look like. So the base year, which is 1993, is 100%. Then all other figures are expressed as percentage of the base year figure. So 1994 will be 105%, and 1998 will be 160% for net sales. Okay. Now, as I mentioned to you, the interpretation is the same or is similar. So if we look at when we're doing the interpretation, if the figure is above 100%, then it means there's growth. So for the net sales, the 1994 figure, there's growth of 5%, and for 1998, growth of 60% using 1993 figures. If the figure is below 100, then that would be a decline. So assuming it was 95, then it means that there was a decline of 5%. So the interpretation is similar, but because we are using absolute amount. So for instance, if we did determine the amount of change between 1994 and 1993 and express as a percentage of 1993, the net sales would have been 5%. So the interpretation is similar. Okay. So once we do this, it can help us maybe plot. We can plot it on a diagram. So if we have a graph showing all these coordinates, it will tell us the behavior of the item. And once we know the behavior of the item, it can help us take vetting positions. So for instance, if you do it, it may show that after every 2 years, it will rise for 2 years, then dip the third year. So that will be the pattern. So that is a trend. And once you know this trend, then it means that when we move into the third year, you know that there's going to be a dip. So what should we do to ensure that we don't dip? So that's what we do with the trend analysis. Any question? Any question? Okay. The next one is vertical analysis. And for the vertical analysis, we do the individual components of the financial statement. So we can do a vertical analysis for the income statement, and we can do the vertical analysis for the state of financial position. We can even do it the cash flow statement. Now, what we'll do is that if you pick the component of the financial statement, by convention, we pick an item that is of most significance in that component of the financial statement. So if we pick, say, the income statement, we'll use net sales or turnover as the most relevant item. If we're doing it for the state of financial position, we will choose total assets as the most significant item. Now, once we choose this, all the items in the component of the financial statement are now expressed as percentages of that figure. So, for instance, if we look here, we have income statement. So, if you look at the income statement for 1998 and 1997, but what we do is that we're doing it based on the 1998. So the net sales or turnover is chosen as the base, which is equated to 100. So you see that net sales is 100% for 1998 and 100% for 1997. Then all figures below it are expressed as percentages of the net sales figure. So the next one will be cost of products sold, which is 4,856 for 1998. So the 4,856 is expressed as a percentage of the 18,280. So 4,856 over 18,284 times 100 will give you 26.6%. If you express 13,428 as a percentage of 18,284, it will give you 73.4%. So that's what we'll do. So we'll convert all of them into percentages using the most significant item. In this case, we're talking of net sales. Now, so once we have done that, we can discard the dollar amount so that the statement will be in percentages. Now, this statement is referred to as a common size statement. Okay. Once we only use in percentages, refer to it as a common size statement. And if we do the analysis, we can see that we are doing vertical analysis or we're doing a common size analysis. We're doing a vertical analysis or we're doing a common size analysis. Okay. Any question? Any question? When I ask you to ask questions, you are not asking questions. When I ask you questions, you are not responding. So how do we make progress from here?
The network has been really on and off, so it's very difficult to follow what you are doing.
Your network is going off and on.
Yes, please. It keeps freezing. It keeps going on and off.
Means you have to invest in.
I don't think it's peculiar to me. It's happening. So we put it on the page, but because I got to source of information, and before I realized we had moved on to tools and techniques, and so I lost you there.
Sorry. But so what we're discussing, have you been following? So the vertical analysis, have you been following? President?
Yes, please. I got into the middle of it. That's how I said, hello, Doc.
Yes,
I'm saying that by the time I got off and came back, we were already in the middle of it, so I can hardly make headway.
I was in the middle of which one?
Hello, Doc. Please, can you hear me?
Yes, I can hear you.
I said I had to leave the page and come back. When I came, you were in the middle of the vertical analysis tool. So I had lost. I'm saying that by the time I left and connected again, you were in the middle of it, so I couldn't get the understanding of this one.
Okay. Now, so
I had to leave and reconnect again.
All right, thank you. Well, let me see if I can explain it further too. So, always saying that if we're doing vertical analysis, you need to we do it for the components, the various components of the financial statement. So we can do it for the income statement. We can do it for the state of financial position or the balance sheet. Now, if you're doing it, what you do is that you pick a most significant item in that component. And I explained to you that by convention, we use the net sales or revenue or turnover as the most significant item. And that is equated to 100%. Then all the figures below it or in that statement are expressed as percentages of the net sales or the significant item that we have chosen. So if you are doing it for the statement of financial position, we use total assets. So total assets is equated to 100%. And we now express all the figures in the statement of financial position as a percentage of total assets. So that's what we're doing here. And I was explaining to you that if you look at this, what we have on the screen, 18,284, which represents the net sales, will be equated to 100%. Now, what we'll do next will be 4,856 over 18,284 times 100. It will give us 26.6. Then 13,428 over 18,284 times 100 will give us 73.4. So this now, we go through all this. And once we've gone through all this, we have percentages representing the various items. And as I explained to you that you can discard the dollar figures, or if they are city figures or whatever they represent. So you have only percentages. And I explained to you that these percentages, we will now call the statement as a common size statement. So if we are doing analysis based on these statements, then we can say that it's a common size analysis or vertical analysis. So it's either common size analysis or vertical analysis. Okay, that's what we go through and we had to come back. Now, this is how to interpret it. You see, once we have converted them into percentages, we can either interpret in percentages or in CD and pesos, because a CD is also 100 pesos. A CD is 100 pesos. So we can either use a CD or we can CD and pesos, or we can use percentages. So if I'm interpreting it using the CD and pesos, I say that for every CD of sale made, which is 100%, for every CD of sale made, it costs the company 26.6 pesos, leaving 73.4 pesos as gross profit. So I'm interpreting it in CDs and pesos, but I can also interpret it in percentages. So I can say that the gross profit is 73.4%, or the cost of sale was 26.6%, and it's now resulted in a gross profit of 73.4%. So you can either interpret it in percentage or in CD term, in CD pesos. Now, what you're doing, the kind of analysis that you're doing, one issue, it is not every item that you have to comment on. Remember that it is analysis. Okay, it is analysis. So you need to now try and tease out the actual implications of it. I've also mentioned to you that financial statement analysis is not an exact science. Okay, it's not an exact science. So we cannot be emphatic that this is it. So usually when we're doing the analysis, we use certain words. So for instance, we can say that it appears, or it may suggest, it seems like. What other words can you use? Yes, Andrew.
You can use it can be deduced.
Can be deduced, yes. Good. Calvin. Calvin, you are very annoying because you raise your hand when you ask you to speak, you won't speak. Yes, Jamal.
So can we say it can be interpreted as
okay. Yes, Benson.
I would say it can be analyzed into.
Okay, whatever you want to. It's okay. All right. All right. So that is what you're supposed to be doing. But again, when you are doing it, there are some items that traditionally you need to comment on. So items like the sales, the cost of sales, the gross profits, and net earnings, or earnings before income tax. These are traditional items that you have to comment on. However, you need to also comment on items that are material. And the materiality here will be either the amount involved or the way they happened. So if you look at the items here, you see that there's an item called special charge and it's for only 1998. So that becomes an issue, and if you don't comment on it, then your analysis will not be complete. Okay. So as you do the analysis, you should be looking out for items that are of significance or material. And here we're looking at the amount involved or the way it happened. Okay. Now, so if I'm doing analysis of this, I would say that okay, all right. So I've seen everything. If I'm doing analysis of this, I could say that I could start with the net earnings. That if you look at the gross profit for 1997 was marginally lower than the gross profit for 1998. So whereas the gross profit percentage in 1998 was 73.4, that of 1997 was 73.3. However, it appears that the company was able to manage its expenses so that the net earnings after tax for 1997 appears to be better than that of 1998, because the net earnings after tax for 1997 is 19.2 and that of 1998 was 17.2. So it appears that the performance for 1997 was better than 1998. However, there was an item called special charge, which was only paid in 1998. So, but for that special charge, 1998 would have been better than 1997. So we need to find out what this special charge means, whether it is a one-off kind of activity or it is going to continue. So if it's one-off kind of activity, then it means that going forward, the company is going to appears to be doing a recovery and will be doing better than the previous years. But if it's going to continue, then it's going to affect the earnings. Okay, so I have just looked at the net earnings 1997, and I'm saying that it appears that it's doing better. But I'm saying that if we now take out the special charge, the 1998 would have been better, because that special charge is only for 1998 and not seen in 1997. So that's how to look at the analysis. Any question? Any question, comments? Any question, comments? Okay, all right. Now the next is ratio analysis. So if you compare one figure in terms of another, then that is a ratio. But if we use accounting of financial data, then we see that it is a financial ratio or accounting ratio. Ratios may be expressed in various forms. They could be in percentages, in fractions, in the actual ratio. Okay. Now, ratios are important, and we need to understand that when we compute the ratios will be pointers. They will point into areas that require further investigation. But ratios are important because they can help us evaluate a company's financial position and operation. And through ratios, we can make comparisons with either the company's own data or with other companies or with industry. So ratios are very important. But what we need to understand is that what comes out will be symptoms. Okay, so once there are symptoms, then we need to now do investigation to weigh on net the true situation. So ratios are very important, and because they are important, they are the major tools that are used to do financial statement analysis. Now we have different types of ratios. We have ratios that can help us measure the entity's ability to meet their maturing dates. So if we're looking at an entity's ability to meet their maturing dates, then we're talking about liquidity ratios. So we have ratios that can help us do that. We have ratios that can help us measure the levels of activity. And the activities are usually driven by management, and because of that, we can now say that they are management efficiency ratios or efficiency ratios. We have ratios that can help us evaluate the long-term ability to an entity's ability to meet its long-term obligations. So we refer to them as solvency. So ability to meet long-term obligations is a long-term measure. An ability to meet current obligation is a short-term measure. So liquidity is a short-term measure and solvency is a long-term measure. Then we have ratios that can help us measure whether an entity is making a satisfactory return. So we talk of profitability. But we can now break the profitability and call another set of ratios as investment ratios, because we use them to analyze the shares of a business as an investment. So we can treat them as part of profitability, but we can also look at them differently because they are specialized. So these are the major categories of ratios that we will be discussing. Any question? Any question? Any question, comments? Okay, all right. Yes, Steven.
I just want to know if market ratios are also applicable here.
Sorry, your line is not.
Okay.
Yes.
Okay, I just want to know if market ratios can also be applicable here.
Market ratings.
Ratios, sir.
There's a background noise. Yes. Yes, Steven.
Hello, sir.
Yes.
Yes, please, I just want to know if market ratios can also be applicable here.
The words, I can't hear the words. Is it market what?
Market ratios, sir.
Can you type it in the chat, please?
Okay.
Jamal. Yes, Jamal.
Yes, bro. Bro, I want to ask a question. But first, today's network is bad. Many of the things we didn't hear clearly. But my question has to do with the vertical. What I heard a little bit of it, but when I tried to do the tally of the percentages, it wasn't adding up to 100. I don't know whether it shouldn't add up to 100 or it has to add up to 100.
He said we should, when you did what?
When I add the percentages of the vertical approach.
When you added,
yeah, I summed all. I didn't get 100.
When you sum all,
yes, sir.
Why do you have to sum all?
I was just doing because it's out of 100. That is why I was doing that to see whether it has to. That would be maybe a means of cross checking to see whether it's accurate. The calculation is accurate. That's what I did.
No, but so you look at the cost of products sold and the gross profit is 100%. Can you see that? If you added the 26.6 to the 73.4, that would be 100%.
Yes, sir.
So you want to add all of it so that it will be 100%.
Yes, sir.
No, you can't do that.
Okay. But in calculating, how do you cross check to see whether you are on track, or maybe you veered off, or maybe your decimal point is having a problem? That's what I was trying to find out. Or do I have certain issues to that? So this is what I want to consider.
Okay, so if you added the 73.4 to the 26.6, it will give you 100%. Now, so the other interpretation is that if you look at the gross profit is after you've taken out the cost of products, and it's going to contribute towards the payment of expenses and profit retention. Okay. Martin.
Yes, sir.
Mute your microphone.
Thank you, boss.
So if you added the 26.6 to the 73, it will give you the 100%. Now, if you subtracted the 24.2, the 12.6, 8.6, 4.4, 1. And the negative this, it will give you this. So if you sum this up and subtract it from the 73 point, it should give you this. And so you see, it has different levels. So when you see the 23.3, if you took out the 6.1 to give you 17.2, so you should be looking at it at various levels and not just say that you are summing all of it. No. If you sum it up, it will not add up. Is that okay?
Okay, Prof. But I'll include that at least we get a recording because his network bad.
Okay, so Stephen, you are asking of market ratio. What are you referring to as market ratio? Market ratio. What are you referring to as market ratio? Yes, Dennis.
Yes, sir. There's something that I experienced some time ago with an accountant. I wanted to find out, as we were discussing the financial analysis, there was a budget that was given to the company for a particular year. And so at the end of the year, they realized that some of the expenses exceeded the budget and some of them were not utilized at all. And so they sort of did some reproportioning, if I should use that word. I wanted to find out, is it even allowed? For example, if you're supposed to spend maybe 10,000 in marketing, but you spend 50,000, and then you're supposed to spend maybe 5,000 in some other expense. And so they deduct from here and put here so that there will be some sort of balancing within the budget. Is it allowed?
Is it allowed by who?
Is it?
It's not allowed by who?
In terms of accounting, is it ethical? Maybe you spent instead of spending 10,000 on marketing, you spend more than that, and so you apportion.
Okay, so when we begin looking at budgeting, we will explain it to you. But you see, a budget is the plan. So when you have a plan, the plan can be reviewed. And if you review it, because certain anticipations that you had did not materialize, then you can review the budget. So if we're anticipating of engaging in some activity, one activity, but because of the current decisions, you have to engage in some other activity, you can review the budget and via the money or the balances to another account. That is possible.
Oh, okay.
So James says that in budget review it is allowed. Okay, all right. All right. So thank you for coming. We'll meet next.
Oh.
Bye-bye. Bye-bye.
Bye, Doc.